Hey everybody, I want to go over today's London session silver bullet. So let's get into it. First thing I want to do is I want to go over the rules of engagement. These are the rules that I use to take my trades. It's basically the ICT 2022 mentorship model. So the first thing I look for is a higher time frame liquidity to be taken. And then I'd like to see a swing high or swing low broken for the market structure shift. I want to see displacement that formed a fair value gap, or a PD array, entry, breaker block, mitigation block, an order block. Entry parameters, I risk 1 to 2, 1 for 2, so 1 risk for 2 reward, and minimum of at least 5 handles. Stop placement can go below the first candle of fair value gap or above below the breaker block, mitigation block, or order block. And then I can move the stop to break even and take partials once price reaches 60% of target. That's optional, okay? Okay, so what happens here when we come here? This dark gray area is the 3 a.m. to 4 a.m. London session silver bullet hour. So the first thing we see is we have these relatively equal highs here. They get taken out. That's a short-term high. You can also classify that as a higher time frame high. And let me show you why I say that, because we're in the 1 minute, so a 5 minute would be higher time frame, right? So let's go back over here and let's see where we're at here. Here's that short-term high. That's 2 relatively equal highs right there, right? On the 5 minute. Go to the 15 minute. Go back over here. See how they're relatively equal highs right there as well. Okay, so the higher time frame got relatively equal highs, they get broken. All right, so it's technically a higher time frame liquidity being taken right there. So I got that question earlier about that, and so I wanted to show that it's a higher time frame liquidity has been taken here. So then we see that a swing low is broken, so we're going down to the downside here. What do we see? We look back. Once the price comes down and breaks that, we look back, we see a fair value gap right here. So there's a fair value gap. Price comes down. It stops on the midnight opening price. Okay, that's what that blue line is, midnight opening price. It's coming back up, comes back into that fair value gap, right? So when you're coming up here, it stops here. You may have been gotten in right there. You probably took your order right there when it got in, and your stop went above here, like our rules. So let me show you why this trade, it didn't work out. I got stopped out here, okay? But let me just show you why it meets the rules, because everyone likes to second guess people when they show their trades or show potential entries, and they're like, well, why did you get in here, and those kind of things. Well, let me explain it. Higher time frame liquidity taken, check. Swing low broken, check. Displacement, yep, check. Price comes back into it, yes. Can I do 1 to 2? Yes. There's a 2, and I'm asking for 5. Let me just roll this up. Look at that. 2, asking for 5. So yes, it's 1 to 2. Yes. Stop placement's above the highest candle, which is right here. You go above that by 1 tick, and it is. That's it. And price came up, and it just took me out. That is the cost of doing business. If you're not able to take losses, you should not be trading. Period. So, you know, this, to me, fit my rules. Would I take this trade again? Absolutely. Why? Because it met my criteria. When I've backtested this, this is the rules that I live by. These are my rules. This is how I trade. This is how I'm going to be successful, by sticking to my rules. You're not going to win every trade. You got to accept that. And this one, it was a loser. It lost. Liquidity is taken again here. It comes back down, trades back down, and it stops right equal right here again. So now we have relatively equal lows right here. Price comes up, stops, comes back down. Again, does not break that line, doesn't take it out, it stops right there. So at that point, you're starting to wonder, okay, do they just not want to go down any further? Right? Because that's usually what happens. You know that that's going to be taken, but right now, they don't want to go any lower. The bodies are above it. Wicks are doing the damage, but they don't want to go below the midnight price. Okay, all the bodies are stopping right here. If you don't want to go down below the midnight open. To be able to take a trade is we need this to break and then use it as support, as resistance rather, and go down, or we need a swing high broken for a market structure shift. So what do we get? Price comes up, takes out this swing high right here. It's for a market structure shift. Do we have displacement in this move? Yes. Can you take this trade? Yes. Where was your stop go? It should go below here, but because you have these relatively equal lows, and we know that price loves to take out relatively equal lows because it's a great target, if you're going to be wrong, I want them to take out these relatively equal lows. It's failed 3 times to come below it. If they're going to take me out, I'm going to make them go below it. So where's my target then? If I do this, it's 2.5. I have to have 5. Where's my target? Well, let me move this up. My target's right here, and that's a 15-minute. I'm going to show these to you when I add the other ones on here. I'll show you where this came from. 15-minute drawn liquidity. It's a swing high on a 15-minute time frame. That happens to be right at my 5 handle target, 2 to 1. Sorry, 1 to 2 rather. There you go. There is a volume imbalance right here, so you might want to come down here. But if you came down all the way to there, you wouldn't have gotten filled, right? And I was fine with a 2.5 handle stop. I was fine with that risk. So that's where I took it. I knew this was a good high because there's additional ones above it. I was fine with that 1 to 2 right there. It's a winning trade. Where could you have gone? ICT says, hey, shoot for 10. That's what you need. You want to be able to at least get 10. So where could you get 10? Well, here's another swing high on the 15-minute. And here's another swing high on the 15-minute. Let me just move these out like this. You can see it. So if you targeted the second one, you're at 7.75. Not enough. Do you get to 10? Yep, you get to 10 going after this target. So can you legitimately see price going 10 handles? Yes. Does it go 10 handles? Yes. Okay? I just want everyone to see that, how that you have your targets based on a higher time frame targets. And so let me just go to the 15-minute real quick, and I'm going to show you this. I'm going to hide this box for a second because you won't see it. 15-minute. So a 15-minute swing high is your first one. Another 15-minute swing high over here. Another swing high over here. There's your 15-minute, your draws on liquidity, okay, for the first one. There's our thing right here. It's hard to see. Okay, so let's, I'm going to take this off and show you something else here. So there's a volume imbalance here, a volume imbalance here, another one here, another volume imbalance here, another volume imbalance here. When I see that many volume imbalances, that tells me that price is going towards something in a hurry, okay? They pull back, they come back, and then they take this right here, this drawn liquidity. They take that right there, okay? Is there any other entries here? Yes. There's a volume imbalance right here, and price trades back into this, and you could have taken a trade off that volume imbalance. Look at the bodies respecting that right there at the bottom, and trade back up. High on your entry at the top of the volume imbalance. Where would you take your stop? Well, since there's so many volume imbalances here, I would have gone below this swing high, because then they'd have to go through several volume imbalances and a fair value gap to get me out, to take me out. It's very much protected, and it's only 3 handles. So 2 to 1 would be right at this second drawn liquidity on the 15-minute time frame. That's still a good trade, in my opinion. Let me throw on the fib here. From low to high, equilibrium is right here. This is in discount, so you can buy, and in discount to buy to go long. So it comes back in over here. Look for my PD array. I find a volume imbalance. That's where it stops, and it's respecting it. I take my trade. Okay. I know there's some people thinking, well, wait a minute, there's a volume imbalance here. Let's throw that on there. There's a volume imbalance right here. Why wouldn't you take this trade? This for first pullback? Well, same reason. Equilibrium's down here. If you go to this high at this point when it's coming back, you're in a premium. I don't want to buy in a premium. So this doesn't. It's not a far enough pullback. I wouldn't need price to come down to this volume imbalance to take the trade. It stopped here and then it went up, and it respected the top of that volume imbalance. I'm not taking that trade. This one though, when price came up here and started coming back down, I'm looking left. Is this fair value gap here long enough? No. Is this volume imbalance long enough? Have I extended it out? No. Here's equilibrium. Now I'm past equilibrium. Now I can look back. Are they coming here? Yes. They're stopped there. They came down and it stopped price right at the bottom of that, and respecting that, I can take my trade right there. Take it up, and there you go. That is how I see the London silver bullets today.